Assalamu alaikum everyone. I hope you are doing well. I'm here with a recording of corporate financial reporting, and today the topic which I'm going to discuss with you, that is statement of cash flow. So we will be analyzing the statement of cash flow, and we will be deciding that which situation of the statement of cash flow is good for a company, what does different activities it represents when we are analyzing it. So starting with the outline of the chapter, that what we are going to cover in this topic. So let's start. So the content of this chapter includes introduction, and then moving on towards, we will be discussing how do we prepare the operating activity section of the cash flow statement, and then we will see that what does the statement of cash flow tells us, and finally we will be checking IFRS reporting with respect to the statement of cash flow. We will prepare the statement of cash flow, and we will also analyze the statement of cash flow. So starting with the introduction of a statement of cash flow, so what does it tells us? So cash flow statement provides a view of the firm's performance. Firm's performance view we can also see from income statement, but income statement is prepared based on accrual principle. So a cash flow statement is not considering the accrual accounting. It only talks about the performance of the company from the cash perspective, all those transactions which are done based on cash, how much revenue, or you can say how much profit it brought from the operating, investing and financing activities. It also summarizes the cash inflows and cash outflows, and if we do that, it will be helpful for us to analyze that why the beginning cash is different than the ending cash balances. All the reasons why the cash, let's suppose if your beginning cash balance in the last year balance sheet is, let's suppose, 3,000, and the current year balance sheet shows us a cash balance of 4,000, so we can see there is an increase of 1,000. Why this increase happen? So all the inflows and outflows activities will be listed in the cash flow statement, so it will be easy for us to interpret that why the cash increased or decreased during the year. Then it also reveals the nature of the activities that give rise to those cash flows. Like I said, our cash is increasing during the year, so what were those activities specifically? We can focus on that. We can also focus on those activities which reduces or which uses the cash from the company. Then because the cash flow and the accrual earnings can differ dramatically, like let's suppose if a company does sales on credit basis, so it will have accounts receivable. Let's suppose its full business is on credit basis, it never gets the sales on cash basis, so there will be a lot of difference in the position of cash because of this accrual base dealings. That's why the statement of cash flow is needed by the companies, that they should report the statement of cash flow along with the income statement and balance sheet. So the cash flow statement basically explains the following things. It explains the causes for the year-to-year changes in the cash. Like I said, last year it was 3,000, this year it is 4,000, so why the cash changes? And then if the cash increases, those activities which increases the cash, which brings the cash for the company, they are also listed, and what the company did with this cash, where the cash was utilized, it is mentioned in the cash flow statement. Moving on towards why the cash flow statement is important for the companies. So let me just move to the next page. Okay, so why the cash flow statement are important for the companies? So if you see that the accrual earning does not tells the true picture of the company's performance or health. Let's suppose, like I mentioned before, a company's whole sales are on account receivable basis. So in income statement, it might have huge amount of sales which will be ultimately resulting in huge amount of net income, but these sales are on credit basis, and maybe most of the sales are already outdated, or they are pending, since means the money collection from these sales is pending more than a year. So maybe all these accounts receivable are near to bad debts. So we cannot rely on the income statement truly to check the financial health of the company or the performance of the company. We really need to look into the cash position of the company. If the cash flow statement is providing a decrease in cash, and the operations or the operating activities are not bringing the cash, they are taking the cash, so in that case company's cash collection is weak, because company has to pay its debts, company has to pay the dividends, company has to pay the interest, so company will not be having the money to do so. And if the company needs the money, then it will be selling its investments or its assets, which is not good. So we also need to look into the cash flow statement to check the performance and the health of the company. So as I said, let's summarize the things why we need to look into the cash flow statement. Because accrual accounting, which is an income statement, it relies on the subjective judgments that may introduce measurement errors and uncertainty in the reported earnings. So because we have sometimes estimates as well, like bad debt expense and these things, so they are subjective judgments. So because of a wrong interpretation or wrong calculation, we could face the trouble later on. One-time write-offs and the restructuring charges require subjective judgment as well. If you write off your bad debts one time immediately, or any other collections which you are writing off, in that case in income statement huge amount of expenses will be there, which might show net losses in that year. But that's one time, that's not continuous. So maybe current year income statement is affected because of this one time write off, but you are not actually paying anything in form of cash for this. So that's why it is going to adversely affect the quality of your earnings in income statement. In income statement you might have huge amount of losses, but what actually happens to the cash flow statement can tell you in more detail. Management can readily manipulate the accrual income by postponing discretionary expenditures for research and development or advertising. Here I will give you a common example that research and development expenditure are required to be expensed, but sometimes management deals with them as the product cost, means they made them the part of the inventory by considering it as product cost. So they postpone the recording of these expenditures. Why? Because this product cost will go to inventory account, and inventory will become an expense only when it will be sold out. Then you will have cost of goods sold, right? So they postpone it, they delay it by wrongly classifying it. So in that case, if these research and development expenditures has taken a lot of money, the cash flow statement will be in better position to tell you the true picture. So because of these above mentioned reasons, analysts also scrutinize a firm's cash flow statement to evaluate its performance and creditworthiness. Basically, if there is a significance difference between the accrual earning, means between the net income, and operating cash flow, means cash flow statement has three sections: operating, investing, and financing. So this operating activity section answer, if it is significantly different than your net income, so it's a red mark. You have to make sure that why we have so many accruals in the income statement, and the collection in the cash format is very less. So we should investigate this point. So let's move on towards the next topic, that is the structure of the cash flow statement, that how the structure of the cash flow statement looks like. So basically it has three main sections: cash flow from operating activities, cash flow from investing activities, and cash flow from financing activities. When we investigate these three sections and we net them off, we find out that how much is the change between the cash of last year and the current year. As I mentioned this before, 3000 was the cash balance last year. Let's suppose suppose this is 2021, and in 2022 you get a cash balance of 4,000. So the difference between both year is 1,000. So when you will investigate these three sections, you will find a difference of 1,000 over here, and all the activities which has caused this 1,000 increase, they will be showing in these independent sections. So first section is cash flow from operating activities. It tells us the increase and decrease in the cash because of the company's operations, firm's profit making activities or firm's operations. Companies perform the operation to make the profit, right? So this section typically tells us about the operating activity, and where we can find out the operations during the year, that is income statement followed by current assets and current liabilities, because whatever is over here on accrual form or deferral forms, that will be reflected in the current assets or current liability section. So these are the three areas which helps us in preparation of the cash flow from operating activities. Moving on towards cash flow from investing activities. So it focuses on non-current assets of the company. So non-current assets includes property, plant and equipment, investments and intangible assets. So companies that decrease, it comprises the decrease in the cash resulting from the investments made where you invested in the productive assets. Productive assets means which helps you in production. So property, plant and equipment they are talking about. Securities are your investments, as well as intangible assets. So as well as the increase in the cash. So this is the decrease when you invest in these, and when you sell them your cash increases because you get the money by selling the property, plant and equipment, investment and intangible assets. So they say as well as the increase in the cash when such investments are liquidated when you sell them. Final section is cash flow from financing activities, and two parts of our balance sheet helps us in preparing it, that is long-term liability and equity. So it comprised the changes in the cash due to transaction related to the financing of the business, such as issuance of shares, or you can say notes, or you can say the repurchase of your debts or your notes payable or bonds payable, and equity when you repurchase them, or when you pay the dividends the cash also goes out. So all these activities, when you, let's suppose when you issue the notes or the bonds, or when you issue the shares, that's an inflow, you get the money. But when you repurchase them or you pay them off, then that's an outflow. When you pay the dividend, that's also an outflow. So when you list all these activities along with their respective balances and you net them off, you come to know how much change in the cash and cash equivalent happened. Like in my example, it was 1,000. So here 1,000 answer will be reflected. There's one important thing which I would like to mention, that is regarding the financing activity. We are talking about two main stuff in the financing activity. One is long-term loan, which includes bonds and long-term notes, right? And plus equity. Equity includes the shares. So on shares you pay the dividend. So dividend is going to be the part of your financing activity. But on bonds and notes you pay interest. Interest is not the part of your financing activity according to US GAAP. They say that interest should be included in the operating cash flow section because it is the part of income statement. So that's why when you will be using the cash flow from operating activity, interest payments will be mentioned here, not the dividend payment, because dividend payment is not the part of your income statement. Payment of dividend will be the part of financing activity. Moving on towards the more details. how can we prepare the cash flow from operating activities? So there are two ways to prepare the cash flow from operating activities. We have direct method and we have indirect method. In direct method, we directly pick up each and every item of income statement and we try to find out did it bring the cash or it has used the cash. So the operating section of the cash flow statement presents the cash transactions related to the determination of the net income. So in income statement, whatever revenues and expenditures brings or took the cash, we will be mentioning them in the direct method. Whereas indirect method does not focus on each and every item. It starts by taking the last item of income statement, that is net income, and then we adjust this net income because it's on accrual basis, so we convert it from accrual basis to the cash basis. So the operating section begins with the net income and then presents all the reasons why and amounts by which the cash flow from operating differs from the net income, which means accrual. So let's suppose if I take the net income, I will add back the depreciation, I will add back the amortization, I will add back you can say increase in accounts receivable. Why? Because in net income I have sales which were on credit basis. Okay, so I will minus, which were on credit basis. So these sales increases my accounts receivable, so I'm going to minus this increase in accounts receivable because the sales I have to decrease them with the credit amount, right? So like this, I will be telling you the full rules in a while, but before that, do remember the net income is going to be adjusted. Let's consider another thing. I will add the decrease in accounts receivable. Why I will be adding it? Because my accounts receivable are collected, they have given me the money, so that's why I am adding that money which I have collected from the previous accounts receivable. They are not current year sales, they are previous sales accounts receivable. So like this, we keep on checking that what has increased the cash, or you can say if something is bringing the cash from the operations, we will be adjusting it into the net income if it is not the part of it, and all the non-cash expenditures will be added back, like depreciation and amortization. The resulting amount in the cash flow from operating activities is same under the both methods. You use direct method, you use indirect method, your answer is going to be same. Both US GAAP and IFRS encourages but do not require the use of the direct method. So they encourages but they don't mandate it that you have to use this method only. Then after this, let's discuss some more details about the direct method. So under the direct method, we mainly, these are the minimum items which are the part of the direct method, but there could be more, but basic are these items which makes our direct method cash flow from operating activities. So first of all, we put those, because main task of the company is to sell the goods, right? So how much money you have collected from your customers, that's the first item, this one. So how do you calculate it? You have current year sales. Okay, so sales of current year, CY means current year. You add back some accounts receivable which you have, let's suppose last year, which was 2022, or let's make it 21. Your accounts receivable were 1000, and in 2022 your accounts receivable was 1200. So it means that there is an increase in accounts receivable of 200 during the year. So it means that these sales of during the year or current year are having credit sales, so we are going to minus the increase in accounts receivable, which is 200. So when I will minus it, I will have my cash sales. Let's suppose it's 1600 last year, my accounts receivable, and this year they decrease to 1200. So how much decrease? That is 400 decrease. It means that I have not done only current year sales on cash basis. I have also collected some money from the previous year accounts receivable, that is 400. So if your accounts receivable are decreasing, it means that you have collected the money from the previous year accounts receivable, so you will be adding that. So like this we will be calculating the cash collected from customers. Then interest and dividend received, they are incomes received. Remember, do not mix them with dividend payments, that's for financing section. Okay, so you have some investments in the stocks and the bonds of other companies, and those bonds has given you interest income, or those stocks has given you dividend, so that's also an income from other sources, so we will be mentioning that. Then other operating cash receipts, maybe you had one equipment which you have leased out or you have given on the rent, so the lease income or the rent income is other operating cash receipt for you. Then comes cash payments to employees, so their salaries will be the part of cash paid to employees, and other supplies of goods and services. If you purchase some other goods or services, in that case whatever cash you have paid for that, like you purchase inventory, you pay cash for that, right? Then comes interest paid. As I mentioned before, interest paid on your debts or your borrowings like notes payable, that will be mentioned in the operating activity section, but the dividend which you pay to your stocks, that is the part of financing activity. Okay, so interest paid is going to be the part of your operating activity, that's an outflow. Then how much taxes you have paid, and if you have paid other operating cash payments like rent expense or something else, that you will be mentioning over here. So they clearly denote for you that note that interest income and interest expense are shown as the component of the cash flow from operating activities. I also made it very clear for you. So let's have a look at how the cash flow from the operating activity section looks like. So moving on towards the picture, this is CVS Health cash flow by the direct method, and you can see how did we calculate the cash flow from the operating activity. They are presenting it for 3 consecutive years. Firstly, the cash receipts from the customers, then the cash paid for the inventory and prescription dispensed by the rental network pharmacies. So all these are their payments. Then the cash paid to other suppliers and the employees, that's also there, so payments are an outflow. Then interest which they are receiving, that's an inflow. Then interest which they are paying, that's an outflow. Then the income tax which they are paying, that's also an outflow. So when you net off all these values, you get to know their cash flow from operating activities. Let's analyze it. So if you see over here, this company is able to produce the cash inflow from the, or you can say their operating activities has provided the cash flow to the company, so their operating activities are in healthy position, and it's improving every year. Can you see, initially it was 8,137, then it increased to 8,412, then it increased to 10,069. So it's a good indication that this company is generating good amount of cash from its operating activities. So this is how the direct method cash flow statement looks like. Let's move on towards the indirect method. So as I mentioned before, in indirect method we start from the net income, and then we adjust the net income to the cash based net income. How do we do that? By removing all non-cash items, and also what we do, we adjust for the accruals. So all of the accruals in the net income are reversed through a series of adjustments. What are the accruals? Accruals includes the accounts receivable and all those things, and then end result should be the same figure calculating by using the direct method. So firm using indirect method are also required to separately disclose. Sometimes they are required to separately mention the interest paid and income tax paid. How do they do that? They mention it at the end of the statement. So usually nowadays company prepare the cash flow statement. They do in the annual reports, their cash flow statement indirect method will be there, but at the end of the cash flow statement direct method calculations will be there, where the interest payments and the tax payments will be clearly mentioned, or they will refer them in the notes to financial statement. Okay, so let's move on that how the indirect method cash flow statement operation looks like. So this is again the CSV company whose this is health care organization, and I showed you before it's a direct method calculation. Now here is the indirect method calculation. So you can see we start from the net income and then we adjust the net income to bring it equal to the operating cash flow. So what all the increases they mention, then operating assets and operating liabilities means current assets and current liabilities, they check them, and then you can see accounts receivable, they are subtracting it, so it means that there was an increase in accounts receivable. Inventory increase because they purchase, so that's why it's subtracted. Then other current assets, if other current assets are increasing we will be minusing them, like here we are doing it, but if they are decreasing we'll be adding them. Then other assets, so whatever categories were there in their balance sheet they have adjusted them like this. Now if you see the answer of this cash flow statement indirect method is exactly the same what we find out in direct method, right? So this is how the difference between the direct and indirect method calculation could be noticed. Now the second learning objective was how to prepare the cash flow statement. So if you are going to find out the stuff which we need to prepare the cash flow statement, so basic sources which we need, that is comparative balance sheet, then we need current year income statement. What I mean from comparative balance sheet, let's suppose if I want to prepare the cash flow statement of 2022 year, then I need last year balance sheet as well to find out the changes, and I need current year means 2022 income statement, and I also need some additional information which are not clear in these two statements. So let's check out a basic example and we will be preparing that cash flow statement with that. But before that, let's quickly have a look at the steps how to prepare the cash flow statement. So firstly, determine the change in the cash. How do you do that? Check last year cash balance in the balance sheet and current year cash balance in the balance sheet and find out how much difference is there. Then calculate the cash flow from operating activities. How do you do that? By checking the income statement and the current assets and current liabilities from the comparative balance sheet. Then you prepare investing and the financing activity section, and you need comparative balance sheet for that sake. So here's the example on which we will be working. Dorogba SA begins business on January 1st, 2019. Using the financial statements given, prepare. So I have some sets of financial statement in the next page. We are required to prepare the cash flow statement on following, means whatever data is given, the direct method and the second following in the indirect method. So I need to prepare the cash flow statement by using the both method. Firstly, let's have a look at it. So this company, can you see in the example, they say it begins operations. It means that 2019 is its first year of operation. They have nothing in 2018 because they were not existing. So in 2018, or you can say the start of 2019, you will find out everything 00 because they did not exist on that year. Okay, Then if you see the first asset which they have mentioned, that's inventory. This is selected data, I must say, it's not the detailed data. So they have inventory, opening balance of course it's 0, and at the end of the year they have inventory of 160,000, they have land of 15,000. Then the liability, accounts payable of 60,000, accrued expenses of 20,000, accounts receivable of 15,000, prepaid expenses of 8,000, cash 34,000, shares 100,000, and the retained earning 42,000. This is income statement side. In income statement, the revenue was 780,000, cost of goods sold was 450,000. Then they have gross profit, that's 330,000. All the operating expenses are mentioned together as 160,000, but they have separated the depreciation out of it so that we can prepare easily the cash flow statement. The depreciation is 10,000, then 170,000 altogether, my all operating expenses. When I deduct them from the gross profit, I get income before income tax. Then we have charged the income tax, and then that's 48,000, and when we deduct the income tax, we get our net income. They have also provided us some additional information. Dividend of 70,000 were declared and paid, so it will be mentioned in the financing activity section. As I said, dividend payments are the part of financing activity. Accounts payable increases resulting from the purchase of merchandise. Where are accounts payable here? So they increase because they purchase the merchandise on account. So some of the inventory purchases were on account basis, so we are going to consider it when we will be calculating the inventory cash payments. And then prepaid expenses and accrued expenses payable are related to operating expenses. So this is operating expenses. So if you see over here, accrued expenses payable means some of the operating expenses are still payable. Like let's suppose in operating expenses you might have rent expense, so but you did not pay it yet, so that will be rent payable, so that will be mentioned inside the accrued expenses payable. It's a liability for you. Let's talk about prepaid expenses. Maybe in insurance in operating expenses there is one expense that is insurance expense, but that's only for the current year which we are putting here, but we paid the insurance for the 3 years, so that will be the part of prepaid expenses, you paid in advance, right? So this is an asset, this is an liability, and both of them are related to the operating expenses. So if total operating expenses are 160,000, we need to see how many prepaid, how many accrued, so that we can calculate exact amount of cash based operating expenses. So now we find out different things that what happened during the year with the income statement and what happened during the year with the assets. Now quickly for our ease, identify which asset is going to be mentioned in which place of the cash flow statement. So if you see here, I have inventory. Inventory is current asset, and current asset is the part of operating activities. I have land. Land is long-term asset, or you can say non-current asset, so it will be the part of investing activity. Accounts payable are liabilities, and that is current liability, so it will be the part of operating activity. Accrued expenses payable, again operating activity because they are current liabilities. Accounts receivable, operating activity because they are current assets. Prepaid expenses, operating activities because they are current asset. Cash, we will be calculating net. Ordinary shares, they will be the part of financing activities, and retained earning is calculated separately. I'll be showing you how to do that. Okay, so we don't directly mention the retained earning, as we know from our accounting basic courses that every year retained earning, let's suppose last year retained earning balance was how much, they mention it was 0. Then every year net income is shifted to retained earning account, so it get 112,000 addition because net income was this, and then the payments of dividend is out of the retained earnings, so 70,000 was taken out. So when you take out the retained earnings, dividend from the retained earning, you get your ending retained earning, that is 42,000. So we don't put this 42,000 in the cash flow statement, we put its parts. So in the operating activity section, I'll be putting this net income, and this 70,000 will be the part of financing activity. So no need to separately put anything, just show the different effects. This goes to operating because this is net income, and 70,000 is financing because this is dividend. So let's prepare some details, and so that we can prepare the cash flow statement. So moving on towards the next one, which is how to prepare the cash flow statement. I'm sorry, my mouse is in trouble, so it is creating issue. Yes, here. Preparing the cash flow statement by using the indirect method. So as we know that there are steps. Step number 1, determine the change in the cash. So when we look into the cash flow statement, initial opening balance means last year it was 0 and the current year cash balance was 34. So there is an increase in 34,000 in the cash, right? Step number 2, find out the changes in the operating activity section, right? So indirect method adjusts the net income for the items that affects the reported income but did not affect the cash. So compute the cash flow from operating activity. First step, add back all the non-cash expenses in the net income, and deduct non-cash credits like non-cash expenditures includes depreciation and amortization. Non-cash credits includes your accounts payable, your accounts receivable, all these things. So let's check again in our cash flow statement data, that what are the things which are on that non-cash basis and what effect depreciation is going to have, because we clearly know that there is no amortization. We only have this one, depreciation. So in our income statement we have depreciation of 10,000, so I'm going to add it back in my net income. Then accounts receivable. So last year accounts receivable were 0 and current year accounts receivable were 50,000. So how much change happened? 15,000 increase. Why they increase? Because sales were on credit basis. So it means that net income includes some sales which did not bring any money. So we are going to deduct it because it's receivable, it's non-cash accrual, right? So I'm going to deduct the increase in accounts receivable. Let's move on towards prepaid expenses. Prepaid expenses shows those expenses which you pay in advance, so money goes from your hand. So they said prepaid expenses are related to operating expenses. It means that during the year company has spent 8,000 cash in paying the expenses in advance. That's why we get the prepaid expenses. So if you paid it, so this is increase, right? But this is not relevant to the current year, it's for the future years. So that's why I'm going to deduct this, or you can say this is not for the current year, that's why it's not for the part of income statement. So we have to show this effect because it has taken our cash, right? So when I'm going to show its effects, I have to decrease my cash, right? So I will be decreasing my net income with this 8,000 because this 8,000 was paid for the future operating activities, but net income did not consider it because it was not relevant to the current year. But now I am considering it, so I'm decreasing my net income. Moving on towards point number, this is 4, it's a typo, and this is 5, and this is 6. Inventory. So our inventory is also increasing. So when inventory increases, it means that we purchase it, and this inventory is used in operations of the company. So we are going to decrease we are going to deduct this increase in inventory from the net income. Then comes and also this is the result of operations, but the income statement does not have it, so we have to show these operations in the operating activity section. Moving on towards accounts payable, they said that we classify already it as a current liability. Accounts payable includes some inventory items which you purchased but you did not pay the cash for them. So how much increase is there in accounts payable? That's 60,000. So if you remember that you have revenue, then you have cost of goods sold, and this cost of goods sold have some inventory items for which you did not pay the cash. So when the cash is not paid out, you have to add it back. So this increase in accounts payable we're going to add back. Then comes accrued expenses payable. So these are those expenses which you did not pay. Okay, so like some of the salaries are due, so we have salaries payable, rent is due, we have rent payable. So if you did not pay these operating expenses, so net income has already deducted them. So if net income has deducted it, nullify them by adding them back. Okay, so I'm going to add back these increase in accrued expenses payable. So what is the final rule? The rule is whenever an asset increase, we are going to minus it because it takes our money. Whenever an asset decrease, it brings the money, so we're going to add it back. Whenever a liability increase, it means we did not pay for it, but operating activities has deducted it, so you add it back so that its effects are gone. Whenever a liability decrease, it means you are paying a liability, it is taking the money from your hands, so minus it. Okay, so this is the basic rule which you should remember. Asset increase, minus. Asset decrease, add. Liability increase, add. Liability decrease, minus. Let's check further. So we are preparing here our cash flow statement as we already calculated all this stuff. So net income for this company was 112,000. Depreciation expense was 10,000. I'm adding it back. Accounts receivable increase with 50,000. So when accounts receivable increase, we're going to minus them. I already explained you that some of the sales did not bring the money, so let's minus it. Then increase in inventory, it's 160,000. So we spent money for this, we're going to add it back. Increase in prepaid expenses, we paid some expenses in advance, so we're going to minus it. Increase in accounts payable, some of the goods which are in sold stuff, then for that we didn't pay the money, so add it back. And accrued expenses are increasing, so it means your operating expenses which you are mentioning in income statement and you are deducting it from the income statement, you actually didn't pay for that, so add them back so their effects are gone. When you net off all these increases and decreases, the change is 93,000. so your net income was 112,000. there is a decrease because of the operations, 93,000. so ultimately you have cash provided by operating activities, 19,000. Let's move on to the next part. Step number 3. Step number 3 says that prepare the cash flow from investing and financing activities. So for investing activities, we will be looking into non-current assets, so like land, equipment. If you purchase them, so they take the money. If you sell them, they bring the money. So if you see, we have land in the question. And then for financing activity, look at your non-current liabilities and equity. So if you remember, we don't have long-term liabilities, we have only equity shares, so we will be considering that. Also we have dividends, so we'll be considering that. So let's proceed towards the preparation of investing and the financing activities. So the full calculation is mentioned over here. We have increase in land, 15,000, so it means we spend the money for this. So when the land increases, we are going to minus it. Then you issue the ordinary shares. When you issue the shares, company gets the money, it brings the money, so we are going to add it in the financing activity section. When you pay the dividend, that dividend, if you see over here, they mention it, and this formula I explained you before, but we don't need to extract the dividend from it because it's clearly mentioned to us. So the dividend paid is 70,000. It takes the money from the company. So let's check how the total effect on the cash flow statement looks like. So here's the full cash flow statement. I already explained you till operating activities. We had only one investing activity, purchase of land. It took the money, so it's an outflow. And then financing activities, we have two. One is bringing the money, one is taking the money. So net is 30,000. So when I add this 19,000 with minus 15,000 and with plus 3,000, the change in the cash is 34,000, which is exactly what we calculated in point number 1. And there is no opening balance, so I add opening balance into this and I get my ending cash balance, which is 34,000. Let's check that how the cash flow statement is different by using the direct method. So direct method is similar to the indirect method, like we start from the operating activity section, but we do not take the net income. We compute the adjustment of each and every item in the income statement from the accrual basis to the cash basis. We will analyze all the revenues, we will analyze all the expenses which are reported in the income statement, and we will check how much is cash and how much is non-cash. So we will only be reporting the cash base, and then we will so all the cash payments and the cash receipts will be very clear. So which things to include, look at the income statement, revenues and expenses item, and then you will be converting them. So the same data set I'm going to use, which I use for the indirect method. So firstly, if you talk about the operating activity section, so in the operating activity section I will be preparing my all the incomes, all the revenues on the cash basis. So I can get the revenue or the receipt by selling the goods and services. I can get the revenue by interest revenue or the dividend revenue on the loans and investments, and then I'm going to deduct all the cash payments which I made to suppliers, to employees, for the operating expenses, for the interest and for the taxes. So let's do this calculation now. The first is cash receipt from the customers. So if you look at the income statement, you will find out that your revenue from the sales, or you can say the sales revenue, was 780,000. But this revenue could be on credit basis, right? And when we checked our balance sheet, we find out accounts receivable basically increased. So it means that these sales are on, some of the sales are on credit basis, which are the part of accounts receivable. So if this is the case, we are going to minus this increase in accounts receivable, because we did not get the money for these sales. So if your accounts receivable are going to increase, you're going to minus it. If your accounts receivable are going to decrease, you're going to add it. Why? Because last year receivables, you are also collecting them, so they are bringing the money. So in this question, I don't have anything from the last year, so increase was for 15,000, so I minus it from my sales. In this case, I get my cash sales. Let's move towards the expenses. So if I move towards the expenses, firstly, the cost of goods sold, the first expense in the income statement is 450,000. Now it means that all the goods which we have purchased during the year, we did not sell all of them. Why? Because we have some items in the inventory. This is the first year of operations for the company. So how much was total items available for sale? They actually purchased them during the year. So whatever was purchases, some of those purchases are sold out, so they become cost of goods sold. Remaining are in inventory. So I need to find out how much money I have paid to my suppliers for the purchases. So cost of goods sold was 450,000, and when I check the balance sheet, inventory was 160,000. So it means that total purchases which I did during the year, they are 610,000. Are all of them on cash, or some are on credit? Check accounts payable, because accounts payable are relevant to these purchases. So when we check our balance sheet, our accounts payable are increasing with 60,000. It means that all of these purchases were not on cash basis. 60,000 we did not pay, they are still payable. So remaining is the payment to supplier, that is 550,000. So what you are going to do, you are going to calculate the cash payments for suppliers in two different ways. Number one, check how much total purchases. So how you are going to do that? Starting with cost of goods sold. If there is an increase in inventory, add it. If there is a decrease in inventory, minus it. And then check accounts payable. So because by this formula you will get how much purchases you did during the year. Okay, and then how much cash purchases. For that sake, if your accounts receivable are increasing, minus it out of these purchases. If they are decreasing, add it. So this will tell you how much payment you have done to the supplier. So for us it is 550,000. Then we also have the operating expenses, right? So let's move towards the calculation of operating expenses. So operating expenses, we will be taking them from the income statement, and then we will see, are these all operating expenses which we have, or we paid for the future years as well, or we did not pay some of the operating expenses in cash. So if you remember the statement in the notes which they have provided us, they said prepaid expenses and accrued expenses are relevant to the operating expenses. It means that we have paid future year expenses in advance, that's why we have prepaid expenses, and some of the expenses for the current year we did not pay in cash, that's why we have accrued expenses payable, a liability. So how you're going to do that? If for example your expenses, prepaid expenses are increasing, you're going to add it. Why? Because you not only paid for current year expenses, you also paid for the future year expenses. So total payment for the operating expenses, you have to add them. If your prepaid expenses are decreasing, so when your prepaid expense decrease, let's suppose insurance. So how do we handle that? We had, for example, last year prepaid expense in our balance sheet. Current year the prepaid expense is decreasing. Let's suppose last year it was 1000, now current year it is 200. So there is a decrease, 800. So what is the journal entry? Insurance expense debit and prepaid insurance credit, right? It means that in the operating expenses I have one expense which is the result of adjustment. I did not pay any cash for it, so that's why decrease in operating prepaid expenses, we minus it. Okay, then comes the accrued expenses. Accrued expenses means expenses payable. So they said accrued expenses are relevant to the operating expenses. It means that if the current year accrued expenses are increasing, we have not paid some of the operating expenses, that's why our accrued expenses are increasing. So sorry, it's over here, increasing. So when my accrued expenses are increasing, let me just explain this point again. Give me a second. Okay. Accrued expenses are liabilities, right? So if for example operating expenses, there is one salary expense, and here I have salary payable, and that's increasing. Last year, which is 2021, it was 200, and current year it is 2022, it is 1000, so it is increasing. It means that 800 of the salaries we did not pay, which we are reporting here. So if we have not paid them, minus them. So increase in accrued expenses payable, you are going to minus. Decrease, your liability decrease when you pay it. So if your accrued expenses payable are decreasing, it means that you are not only paying for current year operating expenses, you are also paying some of the liabilities from the previous year. So payment is not only for this, also for this. So add decrease in accrued expenses payable. So how do we calculate cash payment for operating expenses? So in our income statement, we have operating expenses of 160,000. Then our prepaid expenses were increasing with 8,000, so we add it. And then our accrued expenses were also increasing with 20,000, so we minus it. So ultimately we paid 148,000 for the operating expenses of the company. Moving on towards the next point, which is income taxes. So for us, income tax payment was 48,000. So this is the amount which is equal to what we actually paid, because we do not have income tax payable and we do not have any previous information. So this is the current year income tax payable. So now I'm preparing my cash flow from operating activities by using the direct method. Firstly, cash received from the customer, we calculated it as 765,000. Then payments were three. Firstly, we have payments for supplier, where we calculated the purchases and then we adjusted for the cash purchases. So 550,000 is my first payment. The second payment is for operating expenses, and the third payment is for tax expenses. So these are my all payments, and these are all cash receipts. So when I net them off, you can put it in bracket as well, you get 19,000. So this is exactly the same answer which we get by calculating the cash flow statement using indirect method, and this what they said, your both answers are going to be same. Now after this, whatever is your step number 3, that is investing in the financing activity, it is exactly the same in both methods. You are using direct method, you are using indirect method, the same investing and financing activity section will be there, so that's why we are not calculating it again. So what does the cash flow statement tells us? So the cash flow statement is not just shuffling the balance sheet and income statement. It's actually showing us what is the true cash position of the company. So individuals using a comparative balance sheet and income statement to prepare the company's cash flow statement will most likely have different cash flows than the one prepared by the company, because the disclosed information to us is only in form of income statement and balance sheet, and company has more details. So why our answer will be different in the company? This is because of discrepancies that would arise mainly because of how the changes in short-term operating assets and liabilities are classified by the company. So maybe in company's internal calculation it's different than what we are doing. The cash flow statement reveals the information about operating, investing and financing cash flow. This is what they tells us, and we cannot simply calculate them by reordering the cash flow items in the income statement and balance sheet. We really need to understand the changes which are happening, then it's easy for us to find out that what is the true cash position for the company. So how do we, because our job is to analyze as well, so how do we analyze the statement of cash flow? So basically the most important thing is to find out the difference between the net income and cash flow from operating activities, so that we can know that our operations are efficient or not. And also we need to find out the difference, find out the relationship between operating, investing and the financing cash flow, because a company generates main cash from its operations, and then that cash is invested in assets to earn more profit. Financing activities are for support, but if you don't have enough operations, you don't need to borrow, you just need to maintain your operations. So comparing these three activities is also important for us. In your book, TSMC's group cash flow statement is given on page number 109, but I have taken a screenshot for discussion sake. So this is the operating activity section. I did not put whole because it was very large, but if you see here, firstly we will be comparing the net income with the cash flow from the operating activities. So this is the income before tax for the 3 years for TSMC company, and these are the cash flow from the operating activities. So if you see over here, it's basically increasing every year, which shows a good position. And also you can see the same trend over here in the net income as well, income before tax as well, that it was consecutively increasing. So the trend matches in the net income before tax and the operating activity section. We can further analyze it, but let's quickly have a look at it. So operating activity section for this company shows us a good picture every year. Like in 2014 it was 421,000, but it increases gradually. In 2016 it becomes 539. So it shows a good position of the operations of the company. The important things in understanding the TSM company is to understand what are the basic non-cash items which has affected the company's cash flows. So the depreciation, we know that when we add back the depreciation or amortization, it shows a huge increase in the cash net income. And also the provisions. So provision is basically that money which you set aside for future liabilities, but you are uncertain about them. So you minus these provisions from your income statement. So when there is an increase in the provision, you are going to add it back to remove its effect from the income statement, and when there is a decrease in the provision, you subtract it. So these are the two basic non-cash items which can affect your cash flow statement. Also, the working capital changes also affect your cash flow from operations. Working capital means your operations. So if you see here, basically the working capital can be easily calculated with the help of operating cycle of the company. So what is an operating cycle? It is basically the start of your operations till the collection of money from your operations. So you can say it is a sum of your manufacturing period, sales period, and receivable period. As I said, start of operations till the collection of cash from the operations. So start of operations starts from the manufacturing period. This is the length of time from the acquisition of the raw material. When you start your operation, you purchase the material, right? You acquire the material, and then you convert this material into the finished goods, which is the part of inventory. So this is your manufacturing cycle. Then this finished goods inventory is sold out. So the sales period is the time from the completion of the manufacturing period to the sales of this product. So this inventory, when you sell it, so from the inventory when it stays in the inventory, or you can say when your manufacturing period ends, from there till the sales of inventory is known as sales period. And then the inventory is usually sold out on accounts receivable basis. So I have receivables over here. From these receivables, when you collect the cash, so this is known as your receivable period. So basically operating cycle is in combination of, or you can say it's a total of all these three activities, or these three cycles, from manufacturing, from sales to receivable period. So this is called a cycle because cycle keeps on repeating it, just like the wheel on the cycle. So the money which you are collecting from the receivables, that is going to be utilized to purchase the material again, and then or some old accounts payable for these credit materials will be paid out from the help of this cash. So this is called the cycle because a portion of the cash collected from the customer is used to pay the suppliers and to purchase more material, and it keeps on repeating itself. That's why we call it operating cycle. So getting this cycle to turn means appear again and again, it requires investment. So how do you invest? You invest in receivables, means you don't collect the money immediately from your clients, so your money is blocked in receivable. Also inventory, or you have some other investments like you pay some expenses in advance. So the investment in the company's operating cycle is not only from the company. Sometimes your suppliers also helps you out. How do they help you out? This inventory which you are considering here purchase, maybe the supplier will give you the credit time for this. You don't need to pay immediately for it, so the creditor money will be blocked on this inventory, right? Supplier money will be blocked on this inventory. So the investment in the company's operating cycle does not only represents company's own investment, but this is also the investment made by suppliers. Then employee does not charge you in advance. They wait for the month end and then they get their money. Sometimes their salaries are also payable, so employees are also contributing. Government is also giving you that deferred tax stuff. You don't pay immediately, you pay what your tax file says. So all these people, suppliers, customer, employees, employees and the government, they are also facilitating in making your operating cycle effective. So when the other parties invest in your operating cycle, that is a relief for the company does not have to invest, because if company purchase the inventory by itself, company's money will be blocked. But if the creditor will give you the time, then you don't need to block your money in this inventory. So other people investments make your life easy to operate this cycle properly. Let's move on further towards the net income and the cash flow from operations. So when we are talking about working capital requirement, WRC, so a company's net income in the operating cycle can be estimated. We can estimate it. How can we do that? With the help of WCR calculation. So the working capital requirements is basically how much money you need for inventory, how much money you need for receivable, how much money you need for other assets, and the operating cash. These all are your current, right? Basically working capital requirement is current assets minus current liabilities. So the current liabilities are accounts payable, accrued liabilities, and advances from the customers, means unearned revenues, right? For example, working capital requirement answer is minus. If it is minus, if it is negative, it means that this assets are less than your investments, are less than your borrowings, right? So buying inventory and paying upfronts or accounts receivable is high cost company waiting too long to receive the customer payments or paying suppliers too quickly. So negative will cause trouble, because you have bought huge amounts of inventories for which you have to pay. But if we talk about the positive working capital requirements, it means that you are collecting a lot of money in advance. You are not blocking the money in the inventory, or you are delaying the supplier payments. So in that case your answer will be positive. So if you see over here, all these shows that your outflows are more as compared to inflows, and you will get a positive working capital when your inflows collecting, investing less in inventory, and outflows you're less. So outflows are less and inflows are more, then you will get the positive working capital requirement. Let's move on towards some more discussion, which is what ratio can help us in checking the relationship between our operating activities and the net income, because we said that the operating activity shows us the net income in form of cash, right? So we calculate a ratio which is known as CFF to net income ratio. This ratio tells us that in regarding net income, how much cash flow from operations we have every year. Let's suppose you had 2021 and 2022, so that year net income and its cash flow from operations, you're going to divide them and you can find out how much ratio you get. Let's suppose in 2022 cash flow from operations divided by its net income. So basically the cash flow from operations should be in increase or decrease in relation to the net income every year. So let's suppose last year this ratio was 2.3, means cash flow from operation was higher than the net income, that's why you get 2.2. This year it should also show a consistency. So the positive trend means that it's increasing every year, so it should be 2.3 or it should be increasing. So this is done for all the periods reported to identify either positive or negative trend. So you can see here we have positive trend. Also the example which I shared with you, they showed us a positive trend. Now what do we want exactly? The relationship between the operating, investing and financing activity. What makes companies good if we compare its investing, operating and financing activities? So cash flow from operating activities, if it is greater than 0, means if it is positive, it means that operations has provided us more cash, we receive more cash than we spent. If it is less than 0, means if it is negative, it means that company has spent more cash on its operation than it has collected. So if the company receive more cash, then our next step is we want to see where this additional cash was spent. Did company invest it in the assets? Did company pay back its liabilities? So but when the company has operating cash less than zero, means the answer is negative, then company does not have money to pay for its operating expenses. So how company will be paying? You will find out that the company is borrowing, company is selling its investments to get the money to facilitate its operation. This is not a good situation. So we always want CFFO to be positive. What do we want for investing and the financing activities? So let's have a look at it. For the investing activities, if you invest, it means you had money, that's why you invested. So outflow in the investing activity is a good situation. So cash flow from investing activity, when they are less than zero, means there is negative. It means they are using the cash. It means company is investing the cash which it has generated from the operations. And when it is greater than zero, then it means cash flow from operating activity is bringing the money, and you sell your investment when you are facing the financial issues. So company is selling the assets to finance the operation. This is not a good situation. So unlike CFFO, like I said, operating activities, we want an increase in cash, right? We want positive answer because operations should generate the cash. But for investing activities, we want negative investing activities because they show a good position. Okay, now let's move on towards the financing activity section. So if you talk about financing activities, we want financing activities according to our operations. So when your CFFF, like cash flow from financing activity, is less than zero, this is highly desirable. It means you have less borrowings, you are not borrowing much. So it's highly desirable. In which situation? When your CFFO is greater than zero, means operations are bringing the money, so are using this money to pay for financing. This is a good situation. Why? Because when you get the money from operations, you pay back your principal, long-term loans, you purchase the shares back because you don't need more investment in the market, you pay the dividend. So all these things decreases your financing activity answer, or it uses the cash in the financing activity. It's good indication because your operations are generating the money and you are removing your liabilities. When you purchase the treasury stock, it benefits the company. Why? Because the number of shares in the market will decrease and your ratios will improve. When your cash flow from financing activity is greater than zero, means it's bringing the money, then how do it brings the money? You borrow more, you issue the shares. Then immediately check that what is the situation of your operations. If your operations are negative, it's a bad situation. But if your operations are positive, then it means you are getting more finance because you want to increase your operations. That's why. So when your operating activities are minus, and your CFF means your financing are positive, means you are borrowing more, then it's bad for the company because eventually you will have no money to pay for the liabilities as well. It's a weak indication. So creditors always look into your cash flow statement before granting you credits. So what is the ideal cash flow statement? We want our CFFO to be positive, we want our FFI to be negative, and we also want the financing to be negative. And what's the worst scenario? Your operations are not generating the cash, minus, and your investing is generating the cash because you want to facilitate your operations. Your financing is generating the cash because you want to sponsor your operations. This is wrong situation. This is the best situation. Let's move on towards the conclusion. That is, how can we calculate the free cash flow? So the free cash flow is when you have cash flow from operating activities and you add your cash flow from investing activities into that. What does it mean? The purpose is to show how much operating cash of the company has left over the net of all the investing activities. There is a correction, one second, this is not plus, this is minus. Okay, so you generate the money from operations and you use this money to invest in assets, and if there is something left over, we call it as free cash flow. Okay, so therefore the amount of cash flow generated in that year available for either financing activities or increasing the cash balance. So this free cash flow could be used to pay back your loans or repurchase the shares. Finally, free operating cash flows. So when I talked about the free cash flow, I have focused on total investing activities. I did not limit it to operating assets. I said all investing activities. It could include investment in property, plant and equipment. It could include investment in investments. It could include investment in, you can say, intangibles, right? But what is free operating cash flow? If you want to see that, then in that case, from the cash flow from operation, we will only be minusing the capital expenditures, which is expenditure in property, plant and equipment. So what is my free operating cash flow? Cash flow from operating activities minus capital expenditures, capex. This calculation ignores other investing transactions such like investment. When you purchase the financial security, we say it's investment, right? So it does not include the purchase or sale of investments. It includes only the property, plant and equipment, or you can say capital expenditures, which helps us in performing the operations. So this is how we can calculate our free cash flow. So basically the cash flow statement is you can say it's an extension of our income statement and balance sheet, and it shows the true cash position of the company, because without finance it's difficult for the company to run its business. And this is it for our today's discussion. I will inshallah solve some of the exercises with you. We will try to analyze some of the company's cash flow statement to complete the content of corporate financial reporting. You can find it in the next video. If anything is confusing you, especially when you prepare the cash flow statement operating activity section, please do write me in the comment section. I'll be answering your comments, and I will try to facilitate wherever I can. Take care everyone. See you in the next video. Bye.